Thank you for the warning.
Recording in progress.
All right, good afternoon, everyone. It is the December 9th, 2025 meeting of the Finance Committee. May I have a roll call, please?
Yes, we'll start with Committee Member Santa Maria,
Here.
Vice Chair Harmon,
Here.
Chair Friedman.
Here. And before we go into the comments, I just wanted to make a note that this is the last time that the Finance Committee will be meeting at David Gebhard. We have finally been promoted from the kids' table up to City Hall, so next year Finance will be meeting in council chambers, just like our big brothers on the Ordinance Committee. All right, so with that, first is general public comment. Are there any members of the public who wish to speak to this item that is not on today's agenda, but under the purview of the Finance Committee? There's nobody in chambers. Is there anybody online?
Chair Friedman, no hands are raised.
All right, I will close general public comment and turn it over to Mr. DiMartini for the introduction for the item under consideration today.
Excellent. Thank you so much, members of the Finance Committee. I'm Keith DiMartini, the city's Finance Director. I'm here with Miss Lindsay Moss, the city's Assistant Finance Director, and I'm going to pass it over to her. She'll introduce the item, and we'll call up our speakers. Thank you.
Thank you very much. All right, I'm just going to kick us off and introduce our speakers. So today we have our folks with the Public Agency Retirement Services. They go by PARS is the acronym. We have 3 of them joining us on remotely on Zoom, so they'll come on in a moment. That's Rachel Sanders, Ashley, and Dennis. So 3 folks coming from PARS, and then as well here in person we have Carlos Oblites from Chandler. They manage our portfolio, separate from the Section 115 trust that's managed by PARS. And we can go into first slide. Thank you, Keith. So like I just mentioned, we have these 2 different pieces that we're going to go over today, one with PARS, one with Chandler, and then we'll have plenty of time at the end for questions and discussion. We are aware you have a hard stop at 12:45, so we'll be careful to end the presentation around 12:30 and allow for 15 minutes for questions. Thank you. And our recommendation today is that we recommend that the Finance Committee recommend that Council adopt by reading of title only a resolution of the Council of the City of Santa Barbara adopting the investment policy for the city and rescinding resolution number 24076. The reason for that is that we do have a small adjustment to our investment policy this year. Carlos will go over that in detail, but nothing substantial in that edits to the investment policy. This is just a little reminder about our investment objectives here at the city. It's a little different than how people handle their investments for their personal reasons. We're regulated by many different laws that Carlos is going to go over and explain to you today briefly. But our investment objectives are about safety, number 1, liquidity, number 2, so that we have cash available to pay any of our operating expenses, and then yield last. So that's where it's a little bit different than what folks are used to, where we're not so focused on having the highest rate of return. We're more focused on safety and liquidity. And also, just as a reminder, kind of where we've come from in the last couple years. So over the last couple years, our finance team, we've really worked hard to maximize our investment returns on our cash balances, and we've done that by taking on hiring Chandler, Carlos, and then also working with PARS. Those are 2 new relationships for us, or newer, not brand new, but we've been working with them for a couple years. And that was a part of our core strategy for the Vision 2030 initiative to take on external investment advisors. And the additional income that we've earned using those consultants has far exceeded the fees that they charge us to manage our portfolios. So it's worked out to be a very good dynamic for us. For example, with our Section 115 trust, since our initial contribution back in January of 2024, which was a $2.2 million contribution, the annualized rate of return for that investment has been 11.76%, and that equates to about $447,000 in additional earnings on just that one part. And then for our managed portfolio, which is a much larger portfolio, about $300 million, for the fiscal year 2025, we earned $8.3 million in additional income just off of our investments there. And that income is available, that's allocated out to our departments, so it does go to our departments and help them have additional revenues to help with their expenses. And then the last part that Carlos will talk about a little bit at the end is that we have invested the 2024 revenue bond proceeds into a special project fund. So that's the revenue bond proceeds for the police department and the Dwight Murphy projects. And the additional interest that we're earning in that area is helping us cover any construction-related expenses for those two projects specifically. So another place where we've decided to make sure we're investing and earning as much income as we can on those cash balances. And with that, I'm going to turn it over to our friends at PARS, who are remote, so hopefully they can hear us and take it away.
Yes, we can hear you, and thank you for allowing us to join remotely today. Appreciate the introduction. My name is Rachel Sanders with PARS, and I will go ahead and start us off here. You have all of our contact information on the next slide. And and Ashley and I will start by giving you just a very brief high-level overview of the 115 Trust activity, and then we will turn it over to Dennis Mullins for a brief update as it relates to the investment specifically. So on the next slide, you'll see that there is an overview of the 115 Trust team. So there are actually 3 different partners involved in the 115 Trust team. PARS is the trust administrator and consultant, and we're sort of the quarterback of the team that has been working with the city. However, we don't actually hold the funds in the 115 Trust. That responsibility falls to our trustee, U.S. Bank. And then, as mentioned, Dennis Mullins, who's on the line, as well as the PFM asset management team, ultimately oversee all of the investments. And Lindsay touched upon those core principles required for 115 Trust investing, and all of the portfolios within the trust do indeed meet those requirements for 115 Trust investments. So as we move forward to the next slide here, this gives the city a little bit of a background as to what prompted the establishment of the 115 Trust for pension pre-funding. So you can see here a comparison between the last 2 valuations that you've had done with CalPERS, the city's pension system. The city is right around 69% funded, which is sort of the midpoint that we tend to see with cities throughout the state of California. Of course, CalPERS is dynamic in that sometimes they hit their return expectation, which is currently at 6.8% per their discount rate. In fact, in 2024, they did exceed that as they did in 2025. So that's good news for the city and ultimately helps increase that funded status. But the nature of the beast is that what we've seen with CalPERS over the last several years and what we've continued to see as we project out into future years is that those pension costs are rising. And you'll see that dynamic here on the chart in front of you. Ultimately, many cities like Santa Barbara are setting up these 115 Trust programs as really a vehicle to help smooth out that future expected volatility or rate increase that is expected with CalPERS. So it's a great rainy day trust fund to ultimately utilize when needed. So that said, the next slide provides you with an overview of the 115 Trust program. So this is an IRS approved vehicle that can be used to pre-fund essential governmental functions, whether that be OPEB, which is retiree medical, which the city is not doing currently, or pension for CalPERS, which you are currently doing. So you can see here that you have over $2 million set aside in this dedicated pension account. And ultimately, that money is there to be used, again, for those pension-related expenses. So you can reimburse it back to your general fund. You can direct PARS to send it straight to CalPERS in years where you find yourself in a difficult budgetary position. So again, it really is meant to be there as a rainy day fund. Next slide, please. At this point, let me turn it over to Ashley, and she's going to give you a quick update on the latest activity since you first set this up back in 2023.
Yes, thank you, Rachel. So this next page goes over a summary of the pension plan. So we can see first contribution came in January 2024 at $2.2 million. No additional contributions. And then we have no disbursement. So net investment earnings, $447,000, leaving an account balance of just shy of $2.7 million. The assets are currently invested in the moderate strategic blend strategy, and Dennis is going to be able to provide more information on that strategy and the performance in a few slides. If we go to the next slide, this is a graph showing the history of the contributions and total asset growth over time. So we can see that first contribution coming in 2024. And like I had mentioned, no additional contributions or disbursements, but we see the growth of those assets over time, totaling just shy of 2.7 million as of September 30th, 2025. And if we go to the next page, this page shows the pension plan total return. So Lindsay did allude to this earlier. We see the inception to date annualized return at just shy of 11.8%. And we can see the returns year by year. So the last full year of returns, June 2025, returned 10.13%. And then so far into plan year ending June 2026, which is 3 months of activity shown here, it's returning 4.4%. And I will go ahead and hand it over to Dennis to give more details on the investments and their performance.
Thank you, Ashley. If you go to the next slide, we have a recap of the overall portfolio returns. Your portfolio has been up and running for just over 2 years now. And this is a report as of September 30. This is a very busy report, but put a lot of information on here. On the first column, you can actually see the holdings in your portfolio. These are mutual funds and exchange traded funds. All of these funds are unrelated to either US Bank or PFM. There's no proprietary funds in here. These are the best funds that we can find out on the market. Your total portfolio, this is the first page of 2, your total portfolio asset allocation is roughly 50-50. You're about half in stocks and half in bonds. And again, you can see the holdings there with style benchmarks and asset class benchmarks for each type of fund. For going across the top line, you can see for the quarter 4.42, again 50-50 portfolio. It's going to do about half as well as the stock market and about half as well as the bond market. It should be our rough benchmark. 4.42 is a really good annualized return. If that were to extend over 4 consecutive quarters, you're looking at a very strong rate of return, for a 50-50 portfolio. Year-to-date return 10.52. So that's through 9 months. Anytime you see double digits with a portfolio that's half stocks, half bonds, that's a very strong number. For the year, 8.88. And then for 3 years, 13.04. And what you're seeing here is that for the last 3 years, portfolio returns have been very strong, benefited by a very strong stock market and a strong bond market. As we go back 5 years, we take in the year 2022, where we saw 2022, the stock market was down about 18%, the bond market was down 11%. That goes beyond, when you were in here, but you can see the kind of return patterns that you should expect over periods like that. Let's go ahead to the next page, and we'll be looking at the other half of the portfolio. About half your portfolio is in bonds. And again, you can see for the 1 year return there, 336 for fixed income. Year-to-date returns 6.4% out of the bonds. And it's interesting, you look at this and say, bonds are yielding about 4%. How do you make 6.4% in bonds that are yielding 4%? That means that interest rates settled down a little bit. They came down a little bit over that period. If you go to the next page, I want to talk about the asset mix real quickly, and then I'll wrap up. The asset mix I mentioned is 50-50. You're actually 45.99% in equities. We got a little bit in real assets, which is real estate and global infrastructure. And then between the fixed income and the cash, you're looking at right around 50% of the portfolio. So that's a very quick recap of the portfolio. Since you began with us, 11%, compound annual growth rate for the first 2 years. The portfolio has been doing very well. It's performing on track, and I'll go ahead and stop there and see if there are any questions.
Are there any questions? Yeah, we'll just wait till the end. We'll do the whole presentation, then we'll come back if there's questions.
Okay, now we're going to pass it over to Carlos for his Chandler portion of the presentation. Thank you, Carlos.
On. So I know that we're a little bit tight on time, so I'm going to keep it very succinct. My name is Carlos Oblites. I'm a senior portfolio and investment pool strategist for working with Chandler Asset Management. We are a national firm. We primarily focus on investing funds for local government. The funds that we manage on the city's behalf differ greatly from the funds that you just heard about at PARS. The funds at PARS are intended to cover pension and pension-like liabilities, so therefore they're invested in every manner of investment available on the planet. The investments that we manage on your behalf are different. They're subject to California government code. They are intended to be used to meet your daily obligations, to make payroll, to cover debt service, to cover AP runs, to you name it. So for that reason, California government code restricts what you're able to do, and effectively, you are an investor in the bond markets. The investments are much lower in volatility. They tend to be more income driven, so the returns are going to be lower than what you're seeing in a pension-like investment, but the objectives in order of priority under California code are safety, followed by liquidity, and followed by return. If we go to the next page in the report, our team this is the investment team, this is the engagement team that takes care of the city's investments. I'm the primary investment contact. I'm a strategist. My job is simply to come up with the ideas on how we're going to structure these investments and what's appropriate. It means that I spend a long time poring over your financial statements and over your budget and understanding how you work and working and collaborating with staff to understand what the objectives are to be able to build an investment program that supports the overall financial goals. John McDowell is the portfolio manager. He does the day-to-day trading. He buys and sells the securities. This is an actively managed investment program, so we're not just buying and holding and going to sleep until something matures. We're actively trading in the portfolio to enhance the credit quality of the portfolio, to enhance the return over the long run. Ryan and Gabrielle, Ryan is our COO, and he and Gabrielle are more involved in the client engagement side of things. They help us make sure that our numbers are crunched, that the statements that go to the staff are accurate and timely, and that our meetings get on the calendar. If we go to the next page, I mentioned a national firm. We manage about $43 billion. We manage money for hundreds of local governments in the state of California. Of that and nationwide, of that $43.4 billion that we manage, by dollars, it's 88% local governments, but by head count, it's closer to 98% of our local government, of our business. And if we turn to the next page, the service that we provide the city isn't just simply managing the funds. It's very holistic. It's very consultative in nature. It means that when the investment policy has to be updated, we weigh in on that process. We crunch numbers for the city and connect with staff so that we provide month-end reporting so that they can book their earnings and their investments on a timely basis and on an accurate basis. Like I said, when the city had a strategy to issue bonds, we collaborated with city staff as well as your municipal advisor in terms of what we would be able to do with the funds that you were raising in the capital markets, and that impacted your financing strategy. So, like I said, very, very holistic. And then, of course, we come out here to make sure that you're aware of what's happening in the investments. That's part of the service, is to be here. The things that you don't see behind the scenes are doing credit analysis on all the securities that we purchase, implementing risk management strategies to make sure that the funds are safe and available when you need them, driving down the cost of managing the portfolio by actively shopping for the securities, pitting brokers against one another to be able to get you best pricing. So there's a lot of efficiencies behind the scenes to make this all happen. And if we go to the next page, the overall process is generally when we begin and work through an investment program and building it up, is we start with the investment policy. We collaborated very carefully with staff to update your investment policy. We made several changes when we began, and we have some minor changes for you today, but there was quite a heavy lift at the very beginning to update the policy to make sure that A, it complied with California government code, and B, it included best practices that help you manage risk and optimize the investments for return. When we do that, we work through a cash flow analysis that we implement to see how much money is available and how much needs to be kept liquid. That's part of the process. And from there, we develop the strategies. This is where I do the heavy lifting and do the number crunching and the analysis. But basically, we come up with a strategy, and from there we implement it. And we do the heavy lifting on the asset liability matching. We do the heavy lifting on the credit analysis. We do the heavy lifting on trading these securities and all the other things that I said earlier. If we turn to the next page, this is an overview of. This is my crude attempt at an overview of the capital markets and what's available for investment. And the point of all of this is to highlight that you're really only, in this particular portfolio, in this investment program, because it is subject to California government code, you are very restricted in what you are able to do in this portfolio. Almost everything in that list is not applicable to you, or it's illegal for you to purchase. Really, you're investing in fixed income, high credit quality bond investments where you make your money primarily from interest income and the fair value of each bond, which can move around, and we try and capture that in the portfolio. So it is we call that a total return approach. We try and enhance this portfolio by getting as much yield as possible and as much interest as possible and enhancing the overall fair value of the investments. If we go to the next page, this is an overview. I'm going to focus on the things that kind of matter here. But I mentioned that one of the things we do is collaborate with staff to make sure your investment policy is up to date. We do that regularly. We did a big project at the very beginning. I think I would highlight the bullet underneath the graphic that when we started, some of the things that we did was we focused on expanding the list of investments that are allowed to you under California government code, but were not in the investment policy. And some of these asset classes, a lot of investors avoid because they don't have the resources to analyze the risk associated with it. So we do. That's one of the things that we bring to the table. So we expanded your list of investments to better diversify this portfolio. The second thing we did is we tried to bring the minimum credit quality. You had very restrictive minimum credit quality requirements in the investment policy. We brought those down to match code a little better because, again, we have risk management policies and approaches and analysis that mitigate that additional risk. And then lastly, we added some limits where we thought it was appropriate. Certain asset classes move the volatility around, so we added limits. We added concentration limits on issuers so you don't have too much exposure to any one name. The most recent change, which is what we're talking about today, is that there was a change in California government code. Senate Bill 595 expanded the maximum maturity that can be purchased for a type of security. It's short-term unsecured corporate debt known as commercial paper. They're very high credit quality issuances that are available in the money markets in the shortest durations. Generally, California government code limited you to 270 days. It expanded you to go out as much as 13 months, 397 days. And that's the major change for you today. There's one more minor change. Counties can invest up to 40% of their money in commercial paper. Cities are limited to 25%. There was a change a few years ago which allowed you to go up to 40%. The authors of that bill were uncertain as to whether the United States would follow a zero interest rate policy and liquidity would be needed. So it allowed you to act like a county as long as you had $100 million or over. So you can now invest up to 40%. That's in your policy. We included it. That provision was extended to 2031. So that is captured. That extension is captured in this change in the policy as well. And if we go to the next page, this is the main portfolio, the larger portfolio that we manage. There are other funds that are in your investment program. We don't manage all of them. Staff utilizes the state pool, local agency investment fund, or better known as LAIF, which does a fantastic job of providing liquidity. They keep their most liquid investments in that pool. The funds that they don't anticipate touching over the next year, they get put into the longer investment portfolio. This is what it looks like as of October 31st. It was valued at $278 million. Your yield was 3.53%. That means if I'm looking into the future, based on the way the portfolio is structured today, I should expect to earn interest income of about 3.53%. Think of driving a car. If I'm driving 60 miles an hour in an hour, I'll cover about 60 miles. With a yield of 3.53, it just means in a year, if nothing changes, I'm going to end up with about 3.53% in interest income. The market yield is the yield at which you're reinvesting in. Those yields are coming down. 3 months ago, we were picking up a 466. Today, it's closer to 383. It gives you it indicates, it infers a reinvestment rate, and that's simply because interest rates are coming down, and I can talk about that in a minute. Very high credit quality. If we look at the next page, we see the overall portfolio, which includes also the LAIF, the Local Agency Investment Fund component, when we blend that in, you're averaging 361. You're reinvesting somewhere around 387. The totality of that program is about $319 million. If we turn to the next page, you can see the sector distribution. The key thing I want you to take away from here is one of the things that we brought to the table was to rejigger the balances between these asset classes, primarily to have a strong holding in governmental securities. You can see the treasuries currently make up almost 2/5 of the portfolio. They used to make up 3 months ago about a quarter, and when we started, they made up even less than that. And this is one of your most liquid asset classes, which we can rely on for safety and liquidity. Those are the first two goals that are placed on you by California government code. And then, of course, the other change is that, and I apologize, that was back in July when we started. That's July of 2024 versus the last month end. So the city had about a quarter in treasuries. You didn't own any federal agency mortgage-backed securities. You didn't own any asset-backed securities. You didn't have any municipal bonds. You can see that we've expanded the asset classes to have a better mix of assets that are not as correlated, so we can have more diversification in the portfolio. If we turn to the next page, you can see what that looks like with LAIF. When LAIF is included, it brings those numbers down a little bit because LAIF is about 13% of your investment, and this is where the city relies on its day-to-day liquid funds to be able to make day-to-day payments. Next page, if we go to that, you can look at the term structure of what we looked like when we started back in July of 2024 versus today. The key thing is that we're longer. We're generally longer today than we were. That has protected you as interest rates have come down. It means that you're holding on to your maturities for a longer period of time at a higher yield. You are not forced to reinvest faster into increasingly lower rates, which is protecting your holdings and in turn increasing your total return overall. And I'll show you that in just a moment. If we turn to the next page, it's well, here are the returns. Over the last 12 months, ended October 31st, your return for the portfolio was 5.62%. We have a benchmark. We have a strategy. We generally maintain the duration of the portfolio somewhere around 2.5 years. That 2.5-year benchmark return, 5.28. So versus the risk measuring benchmark, which measures the amount of risk we're taking on to achieve these returns, you're beating it. You're doing quite well. And if I were to compare that versus a lot of the short-term pools that the city relied on prior, you're doing much, much better than that. In fact, since we've been working with you, you've been averaging 5.22% per year. If I factor in the fees that go to pay us for our services, the return was 5.18 versus the benchmark of 4.85, and the shorter investments did shorter than that. Again, these returns are not to the level of what you're seeing in your PARS portfolio, because that PARS portfolio has much broader access to the markets. They do much more than you're allowed to do here, and that's as it should be. You've got a good provider. I know the team over there. I know Dennis. But all I'm trying to say is this is a different approach because of those objectives from code of safety, liquidity, and then after you've met those, it's return and your limitations that you're able to do. I'm about to wrap up. If we go to the next page, this is a history of your yield. It's climbed. We anticipate that into the future it's going to come down. It's already coming down. We're already seeing it. We're just trying to stave that off as much as possible by maintaining our duration targets. And if we go to the next page, you can see that we're also, I mentioned that we got involved when the city did its strategy to issue its bonds. So these are the project funds for the construction of the police station and the Dwight Murphy project. As I mentioned, the staff brought us in to collaborate and connect with your municipal advisor so that they could have a better informed idea of what would happen with these funds when they did the heavy lifting on issuing these bonds. The money came in, it got invested, it's being utilized, there's a spend down on this, there's a draw obviously, but right now you're picking up a 403, that's your future, your yield to maturity into the future that you're collecting on an annual basis the way that you're structured right now. If it gets reinvested because it isn't spent, we're reinvesting somewhere into a 384. The majority of this, about 3/4 of this, are invested in treasury securities. In fact, you're either holding treasury securities, which are the safest investments, or you're holding it in a money market mutual fund, which is very short and ready to be deployed for a draw. The next page shows you the reserve account. Similar, much smaller. This is for debt service reserve, about $3.7 million. You're picking up a 415. You're reinvesting a little shorter. This one goes out a little longer. You've got about 3 years. We go out about 3 years because these are more they're more static. They stay around a little bit longer. Obviously, we don't want to get too long. There's mark-to-market requirements, so we think through these things. We read through the bond indentures to understand how that impacts these funds. So again, it's a very holistic and consultative approach. I would leave you with this thought. If we turn to the next page, the chart on the right-hand side is measuring what the Fed funds rate. It's the rate that the Federal the Federal Reserve, and specifically the Federal Open Market Committee, manipulates. They lower that rate when they're trying to stimulate the economy because it's slowing down, meaning they make it cheaper for people to borrow, so there's money in their hands, so they spend and drive the economy. Or they raise that rate when when inflation is getting too hot because they want to remove money out of the system. Right now, they're lowering rates, and it's anticipated. In fact, today is the 9th. They're meeting today and tomorrow, and we anticipate that tomorrow they're likely going to give us another easing. Rates are going to come down. It means that eventually, for your portfolio, starting with your shortest investments, which is LAIF, the state pool, which we don't manage, but you do have, and then followed by the shorter bond portfolios, those will reset into lower rates when we have a maturity. The longest to take to do that will be your longer portfolio, because as I mentioned, we have pieces that go out to 5 years, and they generally average somewhere around 2.5 years. Why is this happening? If we go to the next page, simply because looking at rates on the left-hand side, if you kind of blur your eyes and look at the left-hand chart, right-hand side, rates are lower, and it's simply because we are towards the end of the business cycle, and there are a number of uncertainties right now into the economy. The One Big Beautiful Bill was a fiscal policy bill, which increased spending that's unsupported by tax revenue, and it means that there's going to be a lot of borrowing, and so that's impacted the term structure of interest rates. But indeed, overall, the economy is towards the late stage of the business cycle, and it's going to need stimulus. So things like One Big Beautiful Bill caused long-term rates to go up a little bit, but short-term rates are generally coming down a little lower. There's a strategy for that. We're implementing it in place to be able to protect portfolio return over the long run. As I mentioned, it's actively managed. This is not a static portfolio, and we think about these things. We position based on where we think things are going to go. But you are squarely meeting your objectives of safety, liquidity, followed by return, and you've had a very good run on the return. Let me stop there. That might be like you're drinking water from a fire hose, but I'll take any questions you may have.
Thank you for the presentation. A lot of information in a quick amount of time, but very intriguing. So I'll open up 2 questions from my colleagues. Member Harmon.
Great, thank you very much. Yes, this is so fascinating, and every time we have, excuse my voice, every time we have a conversation around this, I'm just reminded how incredibly complex your work is, and I'll save it for comments, but just fascinating, and thank you. Just a couple of questions. I know I asked this whenever you first came before us a couple years ago, but this is not meant to be a gotcha, because I think the numbers are so fantastic. I'm just curious how your fees are charged. Is it on a per trade basis or percentage of assets under management, or how? Could you just give me a little?
Absolutely, the latter. It's based as a percentage of the assets under management, and I think I don't have the fee right in front of me, but I think we're managing somewhere around 5 basis points per year. So 0.05% of the average balance of the assets. We look at the average balance for the month, and we charge 1/12 of that 0.05%.
Okay.
And Vice Chair Harmon, if I may add to that, as part of staff's decision to evaluate bringing on an independent investment advisor, which was sort of part of the Vision 2030 effort that we went through a couple years ago, we looked at the trade-off, right? We understood we had an additional cost to have this professional consultant on board, but the additional return that we clearly are achieving through having them actively manage our portfolio versus the city's prior strategy, which was more passive management, has paid dividends, like compounded dividends, right? So it's really worth it from a long-term perspective.
Yeah, I think the numbers bear that out. Couldn't agree more. It's just, when I hear the words active management, I just don't want to hear per trade basis at the same time. So I'm very happy about that. Yeah, fantastic.
I might give you a follow-up. We share the same concern. Active management, when you're looking at stock investments, which you're not allowed to do in this portfolio, we would be in the same camp. We generally, and I think your PARS manager looks to indexing wherever possible. And that's generally a good approach because active management costs a lot of money. So we share the same concern. The bond markets are a little different. Believe it or not, in the bond markets, active management actually adds value. But you're absolutely right. It's not by trade. It's just as an overall percentage of the portfolio. Sometimes we get asked, like, can you do performance-based trades? And anybody can do that, but this is a safety liquidity portfolio. We don't want to be incented to take more risk to
Right.
generate a return for a portfolio that prioritizes safety and liquidity before return.
Thank you. That's extremely helpful. And clearly it's borne out, but thank you. That was a very, very well put. And I guess leads me to my next, just two more questions. And this is around the social responsibility section of our investment policy. So I did see on that list that there are, so theoretically, right, you are investing in pooled investments here or no? I guess is the first question. I'm not quite sure how the pools map on to the bond investments. And then to the extent that we have disfavored types of investments, whether we're talking like conflict, oil, whatever it is, how do you navigate investing in pools and mapping on the disfavored social responsibility element? And it could be that it doesn't apply to you, but I'm hoping you can speak to that.
Absolutely. So the investments are actually, the investments that we manage are not in a pool.
Not pooled.
They are individual securities. You are purchasing individual bonds, and those bonds are sizable. They're what we call index size, so they're very tradable. They're round lots. They're not odd lots. So when you're lending money, you're lending to direct. You're buying a bond, you're a lender. I think you're all aware a bond is a debt. You're lending the money, they pay you interest, they pay you your money back is how a bond works. And so that issuer of that bond is a direct issuer, and that includes Treasury, so the United States Treasury, you're lending to Uncle Sam. You're lending to its federal agencies, the federal agencies of the United States government, and government-sponsored enterprises. You know them as Fannie Mae and Freddie Mac. You're lending to corporate America. You're lending to very high credit quality, normal corporate issuers. Some of them you will recognize immediately. U.S. Bank might be one of them. It could be Meta, it could be Alphabet, it could be Amazon.com, it could be Wells Fargo Bank, it could be any of these issuers. You're also buying other structures that are called pass-through securities, but none of them are a pool. But we do have a social responsibility mandate under the investment policy, and we also we implement that mandate through staff and a management directive that's overlaid through all of this. So the policy is the backstop. You as policymakers give the direction to staff of what you want the city to look like, and then the staff takes that direction and implements it as an actionable event or an action. So with that management directive, basically we look at things and there's areas or names that we know that we need to avoid based on the
lens through
policy,
which
and we
you-
just not buy them.
Okay, amazing. And I'm going to try to, I'm sorry, I have a lot of questions. I'm going to try to move really quickly. On that note, I think this is maybe, I don't even, it's just a comment, I guess, but I personally would like to, I don't support nuclear power being in the disfavored list. However, I think that I may be, I'm not sure that that would be a universally held council position. So while I think we should pass this now, is there a point at which this conversation changes are going to happen? I mean, I don't want to hold this up now, but that stood out to me because I don't disfavor it personally.
Okay, yes, that's fine. Vice Chair Harmon, that's the kind of feedback that staff would like. I think there's a couple different ways to go about this. I mean, we'll look to City Attorney Doimus as well. So you could take an action today. You could recommend an action today to sort of not support the disfavored.
Just remove nuclear power.
Just remove it, right?
Yeah.
That would be a recommendation from this body. It could go to council today. The item would have to be pulled from consent, and then there would probably be an individual vote to remove it from the proposed policy, and it would require a majority approval of the council. So that's one way to do it. Also through, every month, the investment report goes to city council. It's on consent. Council approves it as part of the consent agenda. And so at any time, if there's an item that the city has purchased an investment for, If a council member disagrees or wants to talk about it, the item can be pulled, it can be discussed, there can be a separate action to direct staff to consider an alternative investment option for future investing. So I think those are a couple of approaches. I don't know if City
No,
Attorney?
Mr. DiMartini exactly said probably the most efficient, best options to do that in terms of getting your input of wanting to move this forward with certain recommendations from the Finance Committee.
Thank you. Well, I don't know that, I'll leave it to my colleagues to respond. I'm not sure that that's a great use of our time today, but perhaps something for us to bring up at the legislative committee as well, because I think the nuclear piece, which is what I'm specifically concerned with, is sort of woven throughout city policies. Maybe that's a place to start, and to the extent it gets support at that committee, you know, we can go from there. But my colleagues may want to respond. Thank you. And then my other question, or the only other question I will ask today, is related to the PARS investment possibilities, because I saw on that incredibly helpful list of what's allowed and what's not allowed that you put together, sir, real estate is a no, correct? For the PARS investments, hearing that there's much more flexibility, I sort of have this dream, I'll put it briefly, that the city could play the role of capital partner into, let's say, for example, housing authority development projects where we're not giving land, but quite literally providing equity with the expectation, just like any other investor, that there's a return. Obviously, it would be much lower than in a typical development project. I'm hearing that we can't do it with these funds, but what about PARS? Is that something that would be allowable, and is it worth having a broader conversation about whether that would be advisable? Which I realize allowed and advisable are different things. Could you just speak to that?
Maybe I can ask the folks from PARS to jump in if they are able to answer that question directly.
Yeah. You said allowable, and what was the other?
Just, it may not be advisable,
Advisable, yeah.
but I'm wondering if it's allowable.
There are some areas, I'm going to be honest up front, I'm not sure. We'd have to do a little research. It's certainly not advisable. And the simple reason for that is if the investment would return less than is available in the public markets, or if it would, you know, the investment would go south, then that would be viewed as a, you know, as an ill-advised investment. And the issue with real estate, just as you were explaining, is that if you invest in individual real estate projects, you tend to lose the diversification. The investments that we would make in real estate are geographically diversified, but they're also diversified by user type. So you've got single family, multifamily, light industrial, warehouse, retail, all these different types of real estate, portions of the real estate market. If you were to, we do have quite a few pension funds that will hire a real estate investment manager who will literally go out and, I've seen their presentations, they'll come in and say, you own this warehouse in Chicago, you own this, this strip mall in Alabama, and they'll go through the financial results of each one of those individual properties. Even in those cases where there's direct real estate investment, there's a big focus on diversification by real estate type, by location, geographic, and to build safety into the portfolio. I don't have any experience with the type of investment that you described, but because it's not diversified,
Yeah.
that would be I think the main reason it would be not advisable.
Yeah, and if I can add this from the city's staff's perspective on it, again, I go back to the goal of setting up the Section 115 trust originally, which was to help us reduce our future liability for our pensions going forward. And so staff will be looking to actually taking either all or some large portion of the balance in that trust and sending a disbursement to CalPERS to actually draw down our liability, which will ultimately reduce our operating expenses. So knowing that is the ultimate goal of setting this trust up, staff would need to work with council and work with our expert advisors to see if there's an alternative investment method, such as sort of a real estate deal, on a particular project locally. But that's something, of course, we could look into, but just we need to keep the ultimate goal of the trust in mind when making those decisions.
Yeah, thank you. I really appreciate that. And perhaps, I keep saying when things calm down, we'll do this. I don't know when things will calm down, but at some point in the next year, I would love for us to put our heads together. Because Mr. Mullins, what you say makes such good sense. But the great irony to me is I have so much more confidence in Santa Barbara's value in real estate and land than I do in the fluctuations of the market. I just would it that things would become cheaper here. So anyway, understood and much appreciated. Thank you, everyone.
Thank you. Any questions? I actually don't have any questions. We're short on time. I'll back and fold them into comments. So I'm going to open up public comment. Any members of the public? There are none in the room, so any members online wish to speak?
Chair Friedman, no hands are raised.
All right, I'll turn it over to my colleagues for comment, and then we'll do the motion afterwards. Anybody want to kick off? Member Harmon?
Just reiterate how much I appreciate this, and sort of reminds me a little bit of law school too. It's really great. It's fascinating work. The returns are wonderful, and I appreciate in particular Mr. DiMartini and your staff advocating that we move in this direction, because it's just clearly been such a success, and our whole city is going to benefit. So thank you.
Any other comments? Member Santa Maria?
Thank you, Chair Friedman. Just want to echo that. Thank you to the entire team for this incredible work.
All right, and I will, once again, I want to thank our partners for really stepping up, and now we have a real program and a plan on our asset management. We had a lot of funding out there, and we weren't maximizing it. And today, what just real briefly is what we heard was by hiring on the asset management firms, the costs are borne by the work that they're doing, and the returns are higher, so the returns are paying for themselves, and we're getting additional. So we're actually coming out ahead, even with the fees for the asset management, and I think that's extremely important, because when we are looking at our budget challenges, we can't just keep going to say we need to raise taxes or fees. That we've done it twice. We need to come up with other key strategies for on the income side and the expenditure side, and this is a way on the income side. Where we are able to maximize the returns of investments that we'd be doing anyways. And we have very competent partners from Chandler and PARS on these. And the other, for example, the 115 Trust, that was a way that came from the Finance Department, Mr. DiMartini, almost 2 years ago today. I think it said December 5th in here. But it was the Finance Committee. We worked with you to establish that and then ultimately get a 7-0 on council. And we had a 1-year surplus for reasons that we won't get into, but it was a 1-year thing coming out of COVID. And instead of spending that, we use that as a seed foundation. And we heard today that it's only happened one time in the last 2 years. And that $2.2 million has grown almost $500,000 in 2 years for that fund. And it's the highest performing fund. That's $500,000 that we would not otherwise have right now. And that's split between the general fund and our enterprise funds. So it's important we're looking at the city as a whole. And that's, again, $500,000 that, because we're looking fiscally prudent, being fiscally prudent, that's come up. And then the last thing I'll just say is that again, when we bonded for the police station in Dwight Murphy Field, that was a huge bond, over close to $120 million, if I remember correctly. And we now have that, basically cash on hand, I'm oversimplifying. We could have just parked that money and allowed it to sit there until we get the invoices from the contractors who are building the police station, building the park. But those are going to come throughout the project. Instead, because we have the firms that we have asset management, we've been able to invest that, and we've actually been able to grow the returns on that. And I talked with our finance team yesterday, and because that is such a large, right now, it's going to dwindle over time. It's been able to pay the interest on the bonds. So we're basically getting that interest, and there's been, above and beyond that, a little extra that we are able to allocate back into an anticipated cost of the project, so it doesn't come from the general fund. And that's simply by looking at things creatively and saying there was an opportunity here to grow revenue and address some of that. And then the last part of it is because we shifted to this, our staff who was working internally was doing a great job before. I want to recognize Salvatore. He was doing a great job. But he's now able to work on other things within the city that were also priorities, so we're freeing up staff capacity too. So all these come together. I don't want to belittle it, or short, but I wanted to get that in on the record that we're doing that. And thank you to our finance staff for doing that. So with that, do we have a motion to approve the staff recommendation for today to forward this on to council?
So moved.
Moved by Member Santa Maria, seconded by Councilmember Harmon. All in favor? Aye. Passed unanimously. And with that, we will see you next year at Finance, but it will no longer be here. Like we said, it'll be back into council chambers. Thank you.